Hey, and thanks for joining this afternoon. So this afternoon session will be quite an interesting one. I think very poignant at this time of the year with everything that's going on and been experienced within the business and financial world. And when I say experienced, actually, I don't necessarily mean experienced. I think actually there might be more of a focus here with regards to what is professed or what people or the media are suggesting that you're going to experience. And actually, I'd like to challenge you to think differently. That no, you're not going to experience that because you're going to make a choice to not be in that situation, and certainly in that mindset. So today, it's really all about actually getting a grip of your numbers in the business, understanding the numbers in your business, and by virtue, not flying blind. So, there's been so much that's gone on at the moment. There's so much influence in terms of what's happening with the economy. When you take the global challenges we're facing and the conflict in Ukraine, the price of living challenge, the energy crisis, there's one crisis after another. But the one thing that's really, really poignant here, and what I want to dive into certainly over the next hour, is to give you some insight and challenge you to take control of your numbers and to start to understand your numbers in a way that is really beneficial to driving your business forward. I think in the first instance, and something that is often really quite clear, is the fact that a lot of businesses do find themselves in a place where, what's the easiest way of putting it? In my business, I see a lot of owners that stick their head in the sand, and as a result of that, there is this blissful, unaware focus of what's going on in the business, and often driven by what's in the bank account, very much living hand to mouth. Business is a roller coaster. You've heard all of those analogies and suggestions and experiences before, and you may well experience some of them yourself. I don't know. But the key reason why businesses really struggle is a basic lack of appreciation and understanding how to apply a basic understanding of your own numbers, and effectively in the decision-making process. The wrong numbers or the wrong interpretation of the numbers, and I don't need to tell you, what's potentially around the corner. And too often, there's this gut feel used in decision making, and unfortunately these days, there is a margin that's so tight for error in industry that really, can we always rely on that gut instinct, that gut feel, or do we need to back it up with a better understanding of what our numbers are telling us and what we can glean from our numbers? And most importantly, and this is a bit for me, as I'll go on to explain later on, is a future understanding of what your numbers can be worth. What's that forecast look like? Because the whole point of this is if you have an idea of where it is you want to go and what you want to achieve, and you're able to, through an element of financial mastery, put a forecast in place, then there's a much greater chance of you actually hitting those targets than not. And that level of decision making now can have a massive influence on what effectively is the infinite opportunities of tomorrow. And those opportunities don't have to be what we're being told through the media, what we're being told by colleagues, other businesses, industry that may be struggling. And I think actually many of you out there, in your own reflection and time, when you look back over what's happened the past few years, will actually come to realize that actually, do you know what, we got through COVID. I mean, I know businesses, and I've got clients who started their business or started new ventures or even pivoted their business during COVID and experienced incredible success. And most of it was born through an understanding of what their numbers were telling them. Let's just think about that natural filtering funnel in business. 80% of businesses fail after 5 years. And of those who get through that 5-year period, another 80%, are left to fail over the next 5 years. And so, when you start to look at it in that context, how many businesses would still be functioning now had they got a better understanding of their numbers? Now, one of the things to think about here is, what are the vital signs in your business? If you were on holiday, if you were away from your business, what are the 2 or 3 things that you would want to keep an eye on? And what are the benefits of knowing those numbers? If you understand your numbers, it's going to lead to much greater financial controls. And that takes away frustration. When we don't have tight financial controls, then we can start to get really frustrated because we don't know whether we're making a good decision, which leads to that second point in terms of making better decisions in business. One of the things I often share with business owners is the context that, if you look at money as a definition, the definition for me is an idea backed by confidence. So think about that for a moment. Money is an idea backed by confidence. So knowing your numbers gives you a greater position and strength and ability to make informed decisions. It also gives you greater awareness of the risks and opportunities. Now, many of you business owners out there listening to this today will have varying degrees in terms of the risk that you're prepared and willing to take. And that risk character that you have will depend on you and what drives your business. But if you understand the level of risk, then you can see the level of opportunity. And then there's the focus in terms of, actually, if you're monitoring these numbers, then what about actually being able to examine the issues that are coming up? And again, it gives you the impact of knowing what's coming around the corner, or certain potential for what's coming around the corner. You can be more effective in terms of invoicing, billing, of collecting and paying what it is in terms of the finances moving through the business. And ultimately, money likes to move. That is a reality of business, and it gives you a better cash flow management of that money moving through the business, both in and out. So essentially, when we look at this in terms of our own personal vital signs, actually, what are the vital signs that keep your business alive? So when we look at business numbers as well, the fact of the matter is, it allows you to not be distracted by soft issues. It allows you to be able to have a global conversation. Now, in the UK with Brexit, it means that we've got a global marketplace in which we can communicate. Understanding your numbers and how they move through the business and how you can interpret what they're telling you allows you a global language, to be able to strengthen the opportunities that are in your business. It allows you to communicate within your business as well. So setting the targets, looking at the budgets, and again, we'll talk about a little bit about that in a little while. And then if you think a bit in the context that profit is the route map, and ultimately increased revenues and cash is the destination. And the point here is, having strong operational cash flow in the business allows you to grow. But if you don't know what impacts and has a positive or negative impact on your operational cash flow, then there's a chance that things could go wrong. And you'll have heard the phrase, I dare say, of growing broke or over trading. And sadly, in the many years that I've been doing this, I've seen many businesses who sadly have overtraded. Loads of work to do out there, but they just didn't have the cash to do it. And so understanding your numbers means that you can have a real focus on making sure that all of this works for you. So as we get going, as we're going through this one, again, unless of course you're listening to this as a recording, then pop into the chat box any questions that you may have. Support me today is Sam in the background as our moderator, and she's going to be looking out for any questions you have, and they'll field them to me. Now, if I'm unable to answer the question during today's session, don't worry. I will endeavour to get back to you on an email. Although actually, if you're listening to the live feed on Facebook or YouTube, then again, leave a comment, and again, I would endeavour to respond and answer or join the conversation. So when we start to focus on the numbers, there are a number of key financial reports. Now, many businesses overlook their financial statements and opt that once a year I'll have my end of year accounts, and that's what we're looking for. And they head straight to the bottom line to see what they've made in profit or not, as the factor may be, and then looking to see how much tax do I have to pay. Well, I want to share with you in a moment some of the financial reports that you can have, and just to reinforce the fact that there is so much more information actually contained within the financial reports that you have available to you. And interestingly, nowadays with the likes of Zero, of QuickBooks, of Sage, you've got the ability to call upon these reports just with a few clicks of a button. You can run historic data. You can formulate a cash flow forecast. You can build a historic data and trend lines going forward. There's so much that you can do, and it's just having the confidence to start to look at it. So when we look at this in terms of the available reports, I'm going to go through these in just a little bit of detail in just a moment, but we've got the profit and loss statement. I am sure many of you are familiar with that. We have the balance sheet. And again, these formulate quite a chunky element of your end of year account. So I dare say that you've looked at both of these. Cash flow forecast is interesting because more often than not, this is one that is neglected and not actually created within a business. Nor is the budget or break even analysis and focus. And certainly, if neither of those two are in place, you can pretty much ensure that key performance indicators aren't actually, in the business either. So let's have a quick look at the profit and loss account. So this is really, in the very, very simplest terms, this is the accounting story of how money moves through your business, how you trade, and how you have obviously to, deal with your expenses. It shows your business income, from sales, from bank interest, and from other opportunities you might have in the business. And it also offers the expenses in terms of, what's it costing you to actually run a business. So when we start to look at the, your P&L, there is so much more information in it than just what's coming in, what's going out. And again, if you've got your notebooks on you, you want to grab your pen and write this down as I think a bit of an insight and a reminder, and absolutely an action point. When you look at your profit and loss sheet, it's actually made up of a series of different areas. So we've got revenue, variable costs. I'm going to go through these in a moment: gross profit, fixed costs, and ultimately your net profit. Now, what I'd like you to think about here is for every line entry. So every every line entry in sales. So every sale you make, whatever's in your pipeline at the moment, I want you to think of that as a managerial responsibility. Now, when you look at your organization, your business, who holds responsibility for it? Now, in the start, it might well be you as the business owner. But if you have a team, if you have a sales team, then suddenly the sales and revenue side of life can become their responsibility, and they own that. You've then got your variable costs. So these are the cost of goods or the cost of service. Exactly how much is it costing you to buy your sales? Very simplest context here. If you're a builder and you build a house, you've got to provide the materials. That is a variable cost to you, a cost of goods sold. You add the value by putting the bricks together and the wood on top and the roof. And then at the end of it, you've got your revenue. And as you can see, one from the other gives you what we would term then as your gross profit. But again, on the variable costs, every line entry, managerial responsibility. Who's taking that responsibility, and how are they making sure that there is efficiencies, there is savings, there is lack of waste? It's an interesting one. Again, when you start to look at a business, and when you look at a business over a 12-month period, and there is no control measures in place for their variable costs, for the cost of goods sold, and suddenly we ask a question about, how much waste is there, or what's the shift in material prices. Look at the marketplace currently, you'll see, the sway of prices is up and down, pretty seriously, and there's some big shifts and changes. Is that cost being managed? And by virtue, with the value add that you add to it, is it being passed on as a fair exchange of value? Because otherwise, all you're doing is you're reducing your gross profit, your gross margin. So this is basically your variable cost taken away from the sale gives you your gross profit. And the gross profit is kind of like, how effective are we as a business in terms of delivering our service? And it's a great measurement of what you do in terms of, the effectiveness and the profitability of a business. Same again when we then start to go into the overhead. So your fixed costs or your expenses. Every line entry on your P&L for fixed costs is, guess what? It is a managerial responsibility. So who is responsible for that? Who is looking at the energy bills? Who is looking at your IT, your IT infrastructure, your telephones, your, whatever it is that you're paying in terms of, those fees on a monthly basis, to make sure that you are as optimized as possible. Because if you're not looking at these costs and you just, from 1 year to the next, it's the same, I guarantee there are savings to be made. Now, if you think about it, in all of these areas, the whole bottom line is the net profit. And that's what you walk away with. Now, something I often see in businesses is there is great growth in sales revenue. Cost of goods remains pretty static in terms of growing with the sales. But then what we find is that overheads are outgrowing the sales. And that's because they're not being managed. And that's because no one's actually actively taking an interest in what it costs us to actually run the business. And think of this in terms of, if you had no business coming in, no revenue coming in, your fixed costs remain exactly the same. That's what it costs just to open the door of your business. So who's managing that? Where's the managerial responsibility for each of those line entries? And hopefully that's making sense as we go through. Again, any questions, just please pop them into the chat. So let's just have a little bit of a focus here with regards to the difference between fixed and variable costs. Your fixed costs are expenses that are incurred whether you have or have not got a sale. That's just what it costs to run a business. And then your variables are these are the costs that are incurred because you have sales. Now, one of the questions that often comes up here is wages and people. And there's a balance here between the two, because there will be some who are on a fixed cost because they are salaried in the business. And regardless of whether or not you're doing business, if they're a salesperson or a warehouse person or something of that nature, they still get paid. And then you have the variable costs, where you might have people who are directly associated and attributed in a cost direct to, the cost of goods sold. Often in the trade industry, you'll find that there will be subcontractors and the like who might actually come up as a variable expense. But you can also assign proportions of wage to a variable expense. And again, anybody who wants to dive into that conversation, message me, drop me an email. More than happy to have that chat. So the second we've got then is the balance sheet. Now, the balance sheet is probably the least understood of our financial reports, but it's one of the two most important. The balance sheet provides a snapshot of the overall health of your business. And it's called the balance sheet because it balances the assets with the liability plus the equity, the value that you have within the business. And it represents the overall worth of a company and shows the value of that company for a particular day that it's created. Now, again, if you've not come across these and you don't look at them other than that once a year, go to your accounting software and bring the balance sheet up. And again, dependent on how well reconciled the accounts are, it will tell you what the value of your business is for that particular day. And it's important because profit and loss displays the result of a period, a week, a month, etc., but the balance sheet tells you the story for that day, because it generally is about cash, it's about inventory, it's about suppliers invoice, and they will be changing on a regular basis, and hence the effect, of the balance sheet in terms of the assets against the liabilities, the debts. So the three key parts of any balance sheet are the assets. These are the things that you owe in a business. So the plant, the equipment, land, the cash that you have in the bank, against the liabilities, and this is what you owe. So loans, overdrafts, notes, to suppliers and the like. And then we've got the equity in terms of the net worth of the business. So this is going to be the owner's stake in the business, the shareholding in the business, the retained earnings in the business. So that gives you a bit of an insight in terms of your balance sheet. So we just move past this a second. We then come up to the cash flow forecast, and I said I wanted to talk about this in a little bit more detail as we went through. So cash flow is the money that is moving or flowing in and out of your business, in a month, in a week, in a year. Although it does seem sometimes that cash flow only goes one way, and many of you will see that as being going out of the business, it does flow both ways. Cash coming in from customers and clients who are buying your products or services, and if the customers don't pay on time and purchases for they've made, or some of your cash flow is coming from accounts receivable. In other words, you've got terms in place, so you've got cash that's coming in and out of the business. And then cash is going to be going out of your business in the form of payments for expenses, rent, mortgage, loan payments, taxes, and others. And so these are often referred to as accounts payable. So money moving in, accounts receivable, money moving out, accounts payable. And that's effectively the cash flow of your business. The interesting point here is that the cash flow is current. Your weekly and monthly, you can put an estimate of what that flow looks like, and that's kind of really where there's a major impact in terms of looking to what you can expect. I think you'll probably all be familiar with this phrase: turnover is vanity, profit sanity, and cash is reality. So profit does not always equal cash. And just think about that for a moment. Profit does not always equal cash. And the point on that one is debitors who may have not paid you as yet, creditors who you are committed to pay, the fact that you've got buying stock to bring in, the fact that you have got taxes to pay. And here's an interesting one for you as well. And again, dependent on the size of your business, if you're a startup business or you're a sole trader, I often hear people adverse to paying taxes. And I'd just like to reframe it in a way that maybe you might find it slightly more interesting. So if you look at taxes as you're kind of like, where it is you want to get to, because when you're paying taxes, it means that you're making money. When I hear of business owners who kind of like, I don't want to get to that threshold, they're giving themselves an artificial ceiling. Now, I get that there is then all of the concern with regards to, well, what happens if I get to the higher tax bracket and so on? Who cares? I think the point of reference here is, if you're driving the business forward and you're seeking to grow the business, at the virtue where you're maybe paying more taxes, you're absolutely going to be making more money. And the only caveat I put to this is you've got to just make sure that you've got the very best accountant in terms of who's providing you, tax advice and guidance. And don't forget, when you're in a business, the whole point of business is you're able to pay yourself first and then everything else. When you own a job, you pay everybody else and then you're left with what's left. And that's the difference having a business mindset. And so just think, if you're somebody that looks as tax as a massive negative, and I don't want to go over the threshold and I don't want to be VAT registered, then I challenge you to look in the mirror and just think, why are you in business in the first place? It may just be that all you want to do is own a job, Or if you're in business, then it's kind of like reframe that and have a look at the potential going forward. And then finally, the other bit in terms of the impacts on the profitability and how cash moves through the business is the non-cash items. They've got this great thing called depreciation. So you'll hold assets which over time actually are worth less. But because they're held in the business, then obviously that has an impact. And then you've also got amortization, which is actually the value of currency over a period of time. And I think the greatest example in that is probably, if those of you who got a mortgage, the debt that you owe now on your mortgage is probably not worth the same as it was when you started the mortgage. And what I mean by that is, that debt today won't buy you nearly as much as it would have when you started the mortgage. So what goes into cash flow? Cash flow, is the key in any business survival. And it's one of the main reasons that 8 out of 10 businesses fail within the first 5 years, because they don't understand the difference between cash flow and profit. Or if they did, they didn't manage it well, and they didn't manage the cash flow well enough. So cash is kind of like the oil of an engine. It lubricates, and takes the heat away and the friction away from the moving parts so that they're more fluid in what they do. No oil, effectively, the engine seizes up, and it will seize up pretty quickly. Same goes with a business without cash flow. And this is why every business owner should understand how to manage cash flow in the real life picture of their business, and know what's going in and coming out of the business. And interestingly with this, also forecasting. I'm a massive advocate of, if you've got a cash flow in place, then make sure that you've got maybe 90 days or even 12 months of forecast. It also, I guess, for owners, it will soften the spend based on the profits and cash flow. So it creates that ability to take really informed decisions going forward. It might be also that when you're looking at it in terms of, you remember we talked about the receivables, and again, you may be making profit, but if you're not receiving payments and not able to spend, hence the importance of effective invoicing and debt collection, then again, you're going to find yourself in a real challenging position. And this is just something I want you to think about for a moment here. When we look at the whole point of on aged accounts receivable, this is effectively where you've offered fair exchange of value, you've given some business, or you've had business with somebody and they've not paid you. Now, I'm pretty certain that everyone who's listening to this right now will have experienced that in one shape or form, where you've done something, fair exchange of value, but you haven't been paid. And this bit is the bit that I often struggle with, is when that happens, I often find business owners that are pretty much fearful of asking for that debt to be paid, or having a robust debt collection system in place, because check this out, they're worried about losing that client. And all I'll ask is, if that is the case, how good is that client? Now, just think about that for a moment. It is a mindset piece. So the age receivables, how much money have you got owing in your business that is due you for business that you've done? You've offered the fair exchange of value, there is no problems with it, and they still haven't paid, or you're still waiting that payment. It's definitely worth thinking about. So the other one, buying stock. You may be making profit, but if you do not have stock control, will you have the money tied up in stock? And it can starve you of cash flow and prevent the owner from investing in higher margins or quicker turnover stock. So just think for a moment, how much stock do we have? Have we got inventory control? Do we have an idea of what our fast moving consumables are? Do we have processes in place in order to ensure that there is less or limited, or a capture and wastage? Because again, all of a sudden, and I'm going to share something in a moment with regards to the cash gap, where this is really pertinent. If you run out of cash, you can have all the business lined up in the world, but if you can't pay for the stock to provide the service, not a good place to be. And what about the VAT and tax provisions? Again, you may have money or cash in the bank, but it's not profit, therefore you can't spend it. You've got to remember that as a business owner, you are a sanctioned, if you're above that VAT threshold, government collector of taxes. And again, one of the things that I often find with a lot of business owners is, they don't recognize the VAT that's going onto the invoices. Everything goes into one account. And then suddenly, once a quarter, you've got your VAT bill coming through. And then suddenly we're scrabbling around because we haven't got the money. And again, interestingly, you can have a really interesting conversation with HMRC, and they are incredibly, and I generally mean this, engaging and flexible in terms of, how you can pay. You'll pay, being no doubt, but they will put up payment plans and all sorts to help you if you've got challenging times. But you just got to pick up the phone and have that conversation. But how about this for an idea? What if, rather than actually just putting all of your money into one account, you then broke your bank accounts into various accounts? What accounts would you need? Well, I would say you probably want a day-to-day account. So put a day-to-day account together. I would say you probably want a marketing account. So there's a proportion of what's coming in from revenue that you can assign to marketing, so that you can always be, marketing out there quite clear in terms of where you want to go to and what you want to achieve. I would also say that you have maybe the director's loan account, if you have still got a director's loan that's in play. But the most important one, and the one that will frustrate you the most, is I would absolutely suggest you have a tax account. And I've got to say, when I started business 10 years ago, it was the most sensible piece of advice I'd ever been given. And I've given it to every business owner that I work with to date. Put a VAT account together and get used to that. Every time that you send an invoice out and bill a customer, you take the VAT from that income and you put it straight into the VAT account. And you keep doing that. And you will find that in time, you will have the money that you need, or the funds that you need, in order to always be able to pay your tax. And so the final piece is kind of like that I'd dive into is the non-cash items, such as depreciation and how that appears in the P&L. And whilst it's an accounting theoretical item and it's not cash in the business, you'll see that as a result of that, there is no money to spend on that. Depreciation is money that is meant to be saved. So when the item needs to wear out or needs to be updated, you have the money to replace it. Think about that for a moment. So we often look at depreciation just a case of, every year it's 25% less. Okay, so what have you done to recoup that 25%, to have that available, that when that item is depreciated, that it has in the business zero value? The likelihood is you probably want to replace it by then. Have you got the funds then available and set aside to do that? Again, that might be a depreciation account that you have within the business. So you can see that what goes into cash flow isn't just as straightforward as it maybe seems. You've got areas for the cash shorts coming in, and certainly areas where the company and the business will drain cash. But the bit I think is really interesting is when we start looking at this in terms of the cash gap. Now, make sure you've got your pens and papers ready after this, because I'm going to share with you a whole series. In fact, I'm actually going to say 15 strategies for you to shorten your cash gap. Now, for a lot of businesses that that have this challenge, if you look at this in terms of the cash gap itself, let me just explain how it works. So, in essence, you've got to go and purchase your stock. So your stock arrives. Once that stock arrives, you've got your own personal payable. So what's the terms that you've got in terms of when you paid for that stock? So in this case, you're paying for it in 30 days, and you've got your stock holding here. 60 days receivables. So actually, you can be selling that stock, but you've then given 60-day terms. So as you can see, here's where the goods dispatched. Suddenly you can see from actually, where cash is paid through to when you actually receive cash, there is a 90-day cash gap. Now, that's the bit where so many businesses die through growing broke, because it's here that they run out of cash. And the whole point of this is, if you think of this in terms of your suppliers and your customers, how can I actually, ensure that I'm getting the very best deal from my suppliers, and how can I have the very best terms for my clients? And by virtue of doing that, what you can end up doing is actually then reducing the cash gap. Now, when you think about it, some of the very, very clever IT companies have a minus 30 days cash gap, insofar as you'll go onto their website, you will order, let's say you order a laptop from them, and that laptop will be paid for in full, but it will be delivered in 30 days' time. Think about that as a business model. Think about your supermarket. If the cash gap, was to work in a supermarket where you go and take your trolley, fill it up, go to the cashier, and then tell the cashier that invoice me, we'll pay it in 90 days. It never happened. In business, we accept that this is kind of like a norm. It doesn't need to be a norm in your business, and there are strategies that you can do to overcome that. So let's have a quick look at 15 strategies that I think might be quite useful for you. In the first instance, when you do business, when you start business, it requires a full or deposit in terms of what you're doing on the contract paid up front. Secondly, finish projects so they can be billed and invoice. Now that might sound quite funny, that's pretty obvious, Steve. But the reality on this one is often, sometimes, jobs that you can invoice drift to the right, and we then lose a priority in terms of what we're actually focusing on. So if you've got a date that it's going to be finished, the sooner you can get it finished, the sooner you can get an invoice out. And that leads on to this one, invoice immediately on the completion of a job. Again, the amount of times that I talk to a business owner and say, how many invoices you've got to go? Oh, I've got loads, but I haven't been able to get to them. Well, that's probably a really, really bad excuse and not great for business. Use a delivery and acceptance process at job completion. So again, the whole systemization of actually automating a response, and again leads on to number 5, systemizing billing and invoicing. So you take where you systemize it, as long as you're confident and happy that that the processes and procedures are right, then you're going to be in a good place. Because the job's done, or the purchase has been made immediately. Automatically the bill has gone out there, and there's lots of software that can help and support in that area. Complete billing and invoicing on a weekly basis. So in this case, if there's a lot that's going through, then every week, when do you reconcile? When do you sit down and go through the accounts, and all of those invoices go out? And again, agree terms with the customer. 7-day terms instead of 30. Now that could read whatever you want it to read. If you've got 90 days, it could be 30 instead of 90. Now, the interesting point, when you start focusing on your reduction of terms, it can have a massive impact in a year on releasing cash flow. Invoices. So this is where we're looking at that debt process, and I would say there's a little bit more on this one, but again, through your accounting software, there will be a default setting, but with the default setting is a default text, but you can edit that text. So go in and edit the text, and maybe where you've got the invoice that is now debt and over terms. It might be that the very first thing you do is have a system where you pick up the phone. Now, right now, that might be sending the shutter down your back, but the reality on picking up the phone and having that conversation can be incredible when you have a human-to-human conversation. It's kind of like, hey, look, I wasn't sure if you were aware, but do you realize that you haven't paid this month's invoice? And then someone can say, oh my God, yeah, sorry, I hadn't realized that. Leave it with me, we'll get onto it. So you can move things through. Again, if your business that suffers with that, then soften the blow. Put a sweetener in there. Give a 1 to 5% discount for early payment. Absolutely add interest and collect it on overdue accounts. I guarantee the big players out there will do that and have that written in the contracts for the little businesses, and they will take every interest payment. But especially in the construction industry, many construction trades folk won't do the same. maybe even outsource the entire billing and invoice process. We've got factoring written down there. That's something you can dive into. Although, to be fair, factoring is, in my mind, personally, a last resort in that respect. Reduce inventory by using, inventory trigger points. So knowing when you've got minimum levels. So it is pretty much lean management in that respect. Buy inventory consignments and pay when sold. So again, more swiftly in terms of that lean management. So, as needed, as required. Negotiation on large orders. If you've got suppliers, it might well be, if you know and you're confident in the movement of product, then go to the suppliers and seek better terms. If you've been with them a long time and you're a good payer, seek better terms. Again, number 15. And just a bonus in terms of 16, use progress payments on projects to get paid during the job. Now, many of you in the construction industry, or you'd already be doing that, that there is staged payments. So again, just some top tips for you there. And again, if anybody missed that and you'd like it, then just drop me a message and I'd be more than happy to send you that list through. Okay, so just in terms of the cash flow and the cash flow report, again, this is a very, very simple depiction of our cash moves through the business. And I won't spend too much time on that, because you can pause this and look at it in some detail, and it's pretty self-explanatory. But you can see the revenue coming through. You can see a cost of goods and gross profit, overheads, and again, interestingly, overheads stay pretty much the same all the way through this period. Owner's salary the same, and then net profit from that. We can see what we've made net profit. There's no equity inflow, and we can see the cash position. But then you can start to see how it starts shifting as cost of goods changes in terms of the revenue side of life, gross profit, overheads. But again, this time we can then start to see we're actually in more of a deficit on net profit and the impact that has on our cash position. So when you start to look at this, what it allows you to do, you can see here that, we start to see a deficit in cash position. And then there is a reason why at this point there is cash equity inflow. So that's probably a loan of some description. Again, if you're able to map out in advance what your cash flow needs to look like, then you can avoid train crashes in advance, and you can start to really determine what it is and where it is you need to focus. So we've been through these ones so far. Let's have a look at budgets and break even. Now, this is again, it's often a question that comes up in terms of the difference between markup and margin. And again, this is just a very quick insight to this, and I'll give you the definition of each in just a moment. So markup is in essence, you've got the cost of item, which in this case is 100, and you've got a £25 markup, which is a 25% markup. So item costs £100. And we can see then that actually the profit, the markup, is actually £25, which is 25%. The margin is slightly different. So when we look at the margin side of life, actually the item in this case costs £125, and we put a 20% margin on it, which is a £25 profit. So again, very slightly different when we start to look at it in the two ways. And again, I think once you start to understand, what's going to work best for you in terms of your products and services, you can start to have a meaningful impact on that. So let's just have a quick look. Excuse me. Here's markup. And that's what it looks like. And here's margin. And again, you can see what margin looks like. So break even. There's a really interesting focus here when we start to understand and look at break even within a business. break even is the fact that at the point that the business steps into profitability. And again, you can see on here the calculation for break even. And again, if you go away and grab your income statement, you can start to actually look and work out what your break even is. But effectively, when you start looking at the break even, actually you can get really, really clear on when and how profitable that you are being within the business. And that's incredibly important, because if you don't hit break even, then you're really not going to make any profit. And if you're below break even, then actually the business is costing you, and that will be unsustainable. So understanding your break even by a day, you can understand your break even by an individual, you can understand your break even by an hour, by a week, by a month. But understanding the break even, there is a statistic out there that around about 4:30, every day, 4:30 businesses start to make profit. I have no idea who came up with that statistic, or whether or not it's true, or how factual it is. But you can start to see that if you understand break even in your business, how much confidence does that give you to know that actually after 3 hours of work for an employee, they're then earning profit for the business? At 12 o'clock on a day, we know that we're now starting to be profitable. We know that once we've moved X amount of product, we know that we're then starting to be profitable. I know that once I've got X amount of clients in my service business, I know that I'm then starting to be profitable. And that's the really interesting point. And again, measure it. At what point in a month do you actually hit break even, and know that from that point forward, everything you do is making profit. So just again, going through these areas that we focus, the final one I want to look at is KPIs. So the key performance indicators, and this is the measure of values within a business. What works and what's not working. And we just talked about break even. Break even can be a key performance indicator. But when we look at the financial areas to focus on measurements, you've got your revenue, are sales increasing? You've got profits. Am I making money? Projected cash flow. Do I have enough cash in the business? In terms of my operating cash flow. Equity. Am I gaining or losing equity? Daily sales outstanding, age payables, and again, there's a whole series of current ratios. And what I would say is, don't go diving too deep into the ratios until you've really got the basis of your numbers in the business. But you can then start to see actually financially, there are a whole series of areas that I can put a key performance indicator in place. Now, interestingly, go back to what I was talking about, the P&L, and that every line entry on your P&L is a managerial responsibility. Guess what? You put a KPI that's in there. And then what about the non-financial? So key activities and measures and drivers within the business. Customer service. There's a thing out there called the NPS, the Net Promoter Score. And actually, there are ways in which you can find out what your Net Promoter Score is as a business. And that is effectively, how well you're doing as measured by your customers. And then there are other areas and other opportunities to look at strategies that you can link to KPIs. To KPIs. So what key performance indicators have you got in your business to really start to measure what's going on? Now, hopefully, as we're going through this, you can start to see exactly what we're talking about in terms of the financial development and growth of your business. And the fact that if you then really start to embrace and understand your numbers, which isn't as difficult as you may first think, it can have a massively good impact and positive impact on the health and direction of your business. KPIs, in short, what gets measured gets managed. Okay, so the last, let's say the last, probably take me about 20 minutes or so. So we had an hour and a half today, so there'll be a few minutes at the end for questions if there are any. Marketing. Now, why am I talking about marketing in business? Because really marketing is all about investing money in order to engender a return on investment. And so what I want to share with you is kind of, we call it a secret, but the reality is, once you see this, there's a lot of sense in what I'm talking about. The point here is, these two vehicles that you can see now, the R8 and the Golf, they both share exactly the same chassis. The question really is, which would you have? Would you have the Golf or would you like the R8? Now, again, rhetorical. Some of you probably don't want either, and I understand that. But the point here when we look at this is, actually, if your business is a Golf at the moment, it is very easy with some key focus on other numbers, which I'm going to share with you shortly, to actually become an R8. So when we look at this, we're going to be looking at leverage, and leverage is really about ever more with ever less. It's kind of like this divide to multiply. So how do we get leverage? Well, the first thing is we've got to educate ourselves. And interestingly, a lot of people will think that sales and marketing is an expense. And, I'm not sad to say, but I'm really great to challenge them that it absolutely is not. And it's an investment. Now, when you look at it in that context as an investment, if you think about what you're investing in marketing at the moment, for every pound that you put into marketing, the idea of marketing is you're actually getting more pounds out. Now, that's an investment. Now, I know your accountant will probably almost certainly see this as sitting in the expense column, and yeah, marketing does. But be really, really clear that marketing is an investment. Now, this whole webinar today is about financial peak performance through uncertain times. I've seen all too often that when things get tough, what's the first thing that gets cut in a business is marketing. And it is the most ludicrous thing to cut in a business, because marketing is all about generating leads. And when you do it well, and when you measure it, which I'm going to share with you in just a moment, then actually you'll have much greater financial return in the business. So the measure inside of life really boils down to this quite simply: test and measure. And you've got to test and measure everything that you do in marketing. So if you've got a marketing strategy that you're going to apply, then don't just do 6-7 months of that, and then see if it works. Set in the principles that you're able to test, what's happening in that market strategy, and you're able to maintain and keep an eye on it to see how well it is returning in terms of the investment. One of the biggest challenges for businesses today is, 50% of their marketing strategies probably don't work. The challenge for the vast majority of business owners is this: they have no clue which 50% isn't working. And so as a result, they lose money. Whereas when you test and measure, so for instance, and again, I'm not trying to challenge any marketing companies here, but if you're a marketing company, then build expectations in your clients, give them guarantees, let them know that there's a 90 days to see that our marketing is working, so you can see the results. Educate them that, there is an expectation with what we do. And the point there is, actually, when you start to do that, you will start to get a better return. Because as a business owner, if you're turning around to me and saying, actually, I'm really confident what we do, we're going to test it over 90 days, you're going to see the results, we're going to give you a report, and before you know it, you're going to be making lots more money through the marketing that we're doing. I'm in, and I will keep paying for that marketing all day long. The reality often is a case of, sign up for 12 months, we'll do this, this, and this, we'll send you a report through, and knowing that the report is probably something that isn't understood by the business owner, et cetera, et cetera, et cetera. So getting really, really clear on testing and measuring is absolutely essential. So you go into any marketing, whether you're doing it yourself in-house or whether you're bringing in a third party, test and measure. And why? Because marketing, as I've mentioned, is two sides. And the two sides are simply this: you've got to focus on the acquisition cost. So, how much it's actually costing you to buy a customer versus the lifetime value. Now, if all you ever do is just go for the acquisition cost and just want to get more and more customers, and we don't focus on the life value, how difficult is your business going to be over time? Incredibly difficult. Whereas if we focus on the acquisition cost, in terms of reducing that acquisition cost as much as time. We can do that through test and measuring and then volume in terms of our marketing. What we end up with is a far higher and much more lucrative lifetime value. Wouldn't you all want to know that you buy a customer once and keep them forever? And actually knowing that that lifetime value is coming through. Great example of that one for ourselves. Sadly, there is the funeral industry. We can't get away from that. We're all on that journey. But the lifetime value of the funeral company that has dealt with my granddad, my dad, it's exactly the same company. And why? Because they did such an amazing job with my granddad's funeral and marked it with such respect and, treated us so well. They have absolutely, if you'll excuse this, they've absolutely got lifetime value with us, for probably generations to come, in generations in their business. As starker example that is, think about that in your business. What does it look like? So let's spend a bit of time now, and I want to introduce you to this context of and concept of 5 proven ways to improve your profits. Now, if you still remain skeptical in terms of your numbers and the level of detail that you need to have in your numbers, and that it's beyond just the bank account, and you want to have managerial responsibilities in terms of your profit and loss and being able to read and understand your balance sheet at any particular given time when you bring it up on screen on your accounting software. If you still remain skeptical in those areas, I challenge you not to do that with these. And I challenge you to get your pen and paper out, write them down, and go away and act on them, because they will have a dramatic difference in your business. So the point here, when we look at this in terms of the 5 ways, is that the areas in red are results. That's it. There is no change in terms of the customer, the revenue, and the profit unless there is activity and action and committed action and tested and measured action in the blue areas, in lead generation, in conversion rate, in transactions, in average sale, and profit margin. So when we look at these, and we'll just have a quick look through these in detail, my challenge to you is, as I go through each of these 5 areas, I just want you to reflect in your own business as to whether or not you feel that there is value to be taken from that. And actually, could I do slightly better than I'm doing right now if I put some attention into this area? So let's have a quick look in terms of leads. And I think the first thing that I would want to mention on leads is it's really this. Have you got the ability right now to add a percentage in terms of generating more leads in your business? Do you know right now how many leads you're generating in your business? If you're not doing any lead generation in your business right now, then the answer is quite simply yes. Because if I start, marketing, if I start shouting about what I do, if I start reaching out, if I start asking referrals, if whatever the strategy you start doing, then the reality is you get one more than you had before. But if you're marketing already, actually, if you've got strategies that are going right now, can you actually start to do them better? Where you think of it, who do you target in the market now? Where can you find your clients, and where are they congregated? What's the message you're using right now? And what's going to take them to come and engage with you? And then why will they come and engage with you over anybody else? What's the value proposition and how? Now, lead generation is the first one. That's all very well and good. So we can bring lead generation into the business. But the second piece is we times that by the conversion rate. So the interesting point here is, what is the size of the opportunity? So right now, how many leads do you get coming through to the business at the moment? And how well do you convert those leads? What is it that makes you stand out in the marketplace? What do you do differently? How can you create some uniqueness in what you do? So you're generating these leads, but then through the conversion rate, there is some real focus on the value proposition. You're not doing the same as everyone else. And interesting, here's the thing. We're not going to convert because you're going to be cheapest. Let's go back to acquisition costs and life value. If you're cheapest, what type of clients are you attracting? Cheap clients. If you're attracting cheap clients, how long will they stay for you? As long as you are the cheapest, and then they're gone. There's no loyalty. So again, when we start to look at the conversion rate, there is a whole series of different strategies to put into place in terms of how you position, in terms of how your sales team and how you sell, in terms of value proposition, etc., etc., etc. So when we take the number of leads divided by the conversion rate percentage, what we end up with is quite simply the number of customers that you have. And that's kind of where we want to get to. The more customers, the better. So the next point then is we look at times in our customers by the number of transactions. So how many times can a customer come back and buy from you? Now, again, if you want to do this over a month, year, you'll know better in your business. So is there a number of times that your customers can come back and buy from you? And if that's the case, all right, what is it? What does it look like? How can you increase that? So we take the transactions, and guess what? We divide that by the average sale. So if they're coming back a number of times, every time they come back, how do you get them to spend more with you? Now, just caveat here very quickly that I'm not looking here at any unethical behaviors, and I've never seen that yet to date in the 10 years I've been doing this. But I do know that there exists this concept of actually, unethical behavior out there. But if you think of this in the context of, do you want fries with that? Or actually nowadays is, do you want to go large? McDonald's and fast food are the absolute champions, supremos of the average sale. How many times do you go in there and, I'm not going large, and then they ask if you want to go large, and immediately you go large, because your subconscious is buying on emotion, and at the time you're buying this, fast food, you're probably hungry, and so suddenly you go, I'll do that. But if you had an idea of how much that go large is in terms of the value to the likes of McDonald's, it is in the billions. So what is your average sale? How can you increase the average sale? Now, there's two things to note here on the transactions. And first of all, when you look in the mirror, how much value do you give away? In other words, if you offer a particular service, do you offer that service in its entirety in one hit, or actually are you able to break that service down and determine actually there are better ways I can do this? I can probably break down my service into a more manageable and fair chunks in terms of that fair exchange of value, rather than just feeling that I've got to give everything away. So that's average sale. And once we've got average sale, what we end up with is, guess what? Turnover. How much you're actually turning over in the business. So when we look at turnover, we then look at margin. So margin, and this is a really interesting one. There's a couple of angles to margin straight away. Is in the very first instance, if you want to right now go away from today and make this hour and a half that you spend, or this hour and 20 minutes, however long this webinar is going to be, if you want to make some value from this, here's the interesting point. Go put your prices up by 10% tomorrow and see what happens. You will immediately start to make more money. And the reality is, the vast majority of your clients probably won't even realize that you put the prices up. Some that do will just expect that it's taking you a little while to put your prices up. But when you look at it in that context, you don't need permission. Now, again, the only thing to be mindful of here is take the supermarket example here, the end of aisle items. So your milks, dairy milk, chocolate, that was in the news a while back, I seem to remember, where you put those prices up too much and it's recognized, you'll have outcry, because that is a commodity that people are recognize. So what are the commodities in your business that are a staple diet? You can still put a small margin on it. But generally speaking, if you put a margin, on your price, nobody will notice. So that actually gives you your profit. Now, the other side, on the profit side of life, is I want you to think about is what is the profit that you spend within your business. So if you think of your profit pie on two sides, one side is what you're generating from income. The other side is what you're actually slices you're taking out of the profit, through the expense and the operating costs in the business. Are you, do you spend more in the business for niceties that you don't need? That actually, every time you spend something, here's an interesting one, and I've heard this from, again, many businesses. Oh yeah, don't worry about that. It's an expense, to business. I can write that off as an expense. Well, here's the rub. You can't. Everything you buy in a business is written off against your profit. And the reason that you feel it's just an expense in the business is because you don't understand the numbers fully. So everything that you buy in the business is written off against your profit. So you just need to think about that in clear terms. I want to add some numbers to this now. And we're going to go through a couple of stages of this to really give you an insight as to what this looks like. So first instance, you've got 4,000 customers coming through. You convert at 25% at the moment because you're measuring. And if you're not measuring right now, guess what? Tomorrow, start measuring. And that gives you simply 1,000 customers. That's pretty simple. Every time the customer comes, they buy from you twice. And every time they buy, on average, they spend £100. You can very quickly do the maths there. That gives you 200,000 in revenue. And actually, at a 25% margin, you can then see that you've got £50,000 in revenue. What next? Well, here's my challenge to you when you look at this one. And I just want you to think in each of these 5 areas, are there some strategies that you can pick up? And interestingly, if you struggle on that side of life, then reach out and I will happily give you a complimentary coaching session on actually how to start to look at the 5 ways in your business. So in the first instance, let's add 10%. So you had 10% of lead generation. That means you go out there and what you're doing and you do it 10% better. And if you're not doing anything right now, then that's a no-brainer. You will then end up with, in this case, 400 more leads per month. Through some training, through some focus on service for your customers, through value proposition, you increase your conversion rate to 27.5. Now, just a measure on this one as well. If you're not measuring this and you've got it in your head, well, I'm already converting a lot higher than that, I pretty much guarantee that when you go away and start to look at those numbers, the likelihood is you're not converting as well as you think you are. So working on the conversion rate is, again, infinitely clever. Now, this time, when you look at the number of customers, you've got 210 extra customers. And then we go down to the transactions. So now we're looking at 2.2 transactions per period. And then £110 in terms of average sale. But the interesting point, what happens here is the significant impact on turnover goes up by 92,820. Our margins, we get smart with our margins. We look at opportunities to increase our margins by 10% to 27.5%. When we start converting at 27.5%, we're not converting so much, but actually saving to making that margin, look what happens to the profit. And just think about that for a moment. That's a 46% increase in terms of your revenue, but a massive 61% in your profits. Now, that's all based on 10%. You can put revenue numbers that you feel are most suited. But what would that look like in your business right now? Interestingly, though, there is a health warning that comes with this one. And the health warning is pretty simple, actually. But I just want you to have a think about this one. Is where do you start? Where do you kick off in terms of your 5 ways? Most people will turn and say, let's go for leads. Now, here's the challenge. If you start with leads and you haven't tuned the engine, those leads are going to go straight down the plug. If you start with leads and you haven't tuned the engine, they're going to go straight down the plug. So we've got to tune the engine first. Now, in tuning the engine, the likelihood is there is going to be a fee associated with it. It's going to cost money. We're going to need revenue. We might need more revenue to do marketing. We might need more revenue in actual fact to step above this. Now, when we look at that in that respect, here's what happens. You start with margins. You put your prices up. That immediately brings in cash flow. And cash flow means that you can then start to focus on, the other areas of optimization. We improve the conversion rate. So we already know that the leads are coming through. We then start to convert those leads even better, which means that we're now starting to build with regards to the average sale. So we can improve and increase on the average sale. So we then know that every sale that's coming through on average is earning us more. And then we can start to build in terms of, the number of transactions and finally actually then opening the tap and turning on the leads. Now, you don't have to look at that as a structured approach to you've got to do one by one, but actually you can look at it as a strategy of prioritizing. How do you prioritize to focus on this? And if you then prioritized on these over a 90-day period, it may, absolutely start on margins, look at average sale, number of transactions, conversion rate, and then leads. Now, the next slide that I want to share with you, the next insight is just how much impact this can have over a 7-year period on the 10% increase per year. Now, if you look at the numbers on there, you kind of, 100% increase in from, where you are now today. Now, what are your numbers? What's that 7-year challenge for you? 10% per year look like? And actually, you're thinking right now, well, I can't get a 48.8% profit. Well, could you do better in other areas? Could you improve your lead generation, your conversion rate? Could you increase the number of transactions? When you look at the 5 ways, there is an infinite opportunity of effectively what this looks like with regards to, developing the size of opportunity here. And, it really is a case of the 5 ways are not, a secret. They're not mystic. They are just about activity and about measuring your numbers. So think about everything I talked about financially to start with, and now think about actually if I'm, measuring those numbers or monitoring those numbers, and now I can put activity into improving those numbers, what could happen in your business? Go back to what I said. This is all about financial peak performance in uncertain times. How much certainty could you then start to bring to your business if you know the amount of leads that are coming through? The interesting point on this one, if you think about it in that context, is you start to create predictable cash flow. Wouldn't you like that? How many businesses out there right now are probably worried about predictable cash flow? All it takes is activity, the right activity in the right area, levels of accountability to keep you on track. I want to round off today with one final piece of advice. And again, we've covered quite a lot of ground today. So again, this is going to be a recording that you'll probably be able to find on my YouTube channel. It's called The Power of One. And the Power of One is all about, opportunity to, develop growth in the business through marginal gains. And, when we look at it in terms of, whatever quarter of the year that you're in at the moment, what has that got the potential to look like going forward? So when we focus on these 7 levers and think also of the 5 ways I've talked about, it's when you start to look at the small percentage increases that you can have here. So could there be a small percentage increase in price? We talked about leads and conversions. Could there be a small percentage increase in terms of the volume of business that you're attracting? Could there be a small percentage decrease in terms of cost of goods? How much is actually costing you? Could you be more efficient? Could you, start to, tune in on waste? Could you, have better conversations with suppliers, negotiate better terms? Could there be a reduction in the percentage of overheads and expenses? How much it's costing us, to actually turn up for business every day? Could you actually increase your receivable days? So, be able to invoice swifter, get your invoices paid sooner. Is there a focus that you can really drill down in terms of work in progress or inventory if you are selling a product, and make sure that is truly optimized? And could you actually, pay your own debts, your own credit lines over a slightly longer period of time? These are the marginal gains that, if you take everything I talked about today, where we have talked through the financial reports, where we've talked through the P&L, profit and loss, the balance sheet, where you've had a conversation in regards to cash flow forecasting, in regards to budgeting and your break even in regards to key performance indicators, where I've introduced you to the 5 ways to really increase profit, you can start to see that financial peak performance through uncertain times, it's not in the realms of uncertainty at all. It's in the realms of being certain in what you want to do. And I really encourage you to be of the mindset of actually being in a place right now where, you know what, I'm not doing any recession. I'm going to focus on how I can really develop and grow my business going forward, where I can really take it to the next level. I hope this has been of value for you today. Again, if there are any questions, comments, or if you're watching this as a recording afterwards, then please drop me an email, stevegaskell@actioncoach.com, and I will be more than happy to offer any insights and any advice and support that you may like. But all that leaves me to do is to encourage you to go out there and to perform to your best and actually give certainty to the future of your business. Thanks a lot.